Hello, everyone, and welcome back to Sudden Wealth. I hope this week is starting very well for yourselves. First of all, this past few days have been quite hectic here at the castle. A bit of some family issues going around that had to be sorted out. Fortunately, things are looking much better. So, um, no, those things are what really matter in life. So, I apologize for not posting for a while now, but I'll try to make it up to you guys over the next few days. I'm still considering to do a live stream maybe tomorrow or maybe tomorrow, yes. We'll see if I can this week. Otherwise, I will do it the next week. So, by the way, don't forget, if you do enjoy the content, please consider dropping that like and subscribe. It greatly helps the channel. So, thank you very much for your support. So, stocks keep on moving higher. I do think we're going to test the upper channel of the 4,600 range on the S&P 500. I think there's a good chance that we even gonna bump a little bit ahead. And then it's the same scenario as it was on the downside. So when we crossed below 4,200, and we were about 4,120, 4,150. I said we are now outside of the extreme range of the channel, but we are still, depending on timing, we are still within the overall channel. Meaning, if we bump out of it in 1 week, but we immediately recover the channel the week following, which was exactly what happened and exactly what I mentioned, then the channel is still live. Actually, it's going to be a very bullish sign, because that means that we pretty much went down there to kind of retest a breakout area, and we recovered the majority, the big channel. Also, you had a lot of positive things going around for the markets, for people who were paying attention outside the US. You had deflation in China, you had surprisingly low inflation in the Eurozone, and to me, and also we just came out of summer period, which is naturally inflationary as people work less, produce less, spend more inflation. Surprise, surprise. So in that and I did believe, and I do believe, that as soon as the economists were all agreeing that there's no way we're gonna have a recession next year, and the Fed also agrees, and the big banks also agree, to me, that tells me that the likelihood of a recession has just increased dramatically. Now, also, there was some hidden weakness in the job reports that most people didn't pay attention. Example, you would see something like, 400,000 jobs were created and we only expected 290,000, for example. And of course, the markets would sell off, yields would pop up, because the idea was, okay, job market's still very strong, the Fed will raise rates, stocks go down, bonds go down, and that's it. And the dollar goes up. Now, if you actually looked a little bit into the reports, you would see that full-time jobs were decreasing massively and part-time jobs were increasing massively. You would see that a lot of jobs created were for government sectors, which are unproductive jobs. A lot of people getting second and third jobs because they can no longer afford their lifestyle with one single job. Those are all signs of a weak economy. But if you just look at the number, 400,000, which, very important, it's what the market looks at. So it doesn't matter that I know the underlying situation. What matters is how will the market and the algos react to the news. But what it can tell you is, okay, it's a matter of time before one of these job reports comes very weak, which it has happened. Now, as you know, the market looks forward into the future. So if the job reports are out and they're bad, the market goes up. Why? Oh, job market coming down, prices coming down, the Fed can cut rates. Rates go down, stocks go up, because we've seen this happening. And that's actually quite true, with an exception. When they actually cut rates, stocks go down. Why? Because it has been priced, the rate cuts have been priced before. You see? They have been priced as we go into it. So immediately when it happens, it's a sell the news event. And the stocks come down. People forget. Oh yeah, I want them to cut rates. Don't forget, the exact moment they cut rates, stocks dump. Because the pricing of the rate cuts has already been done in the months before. However, as the money starts to flow into the financial system, you have more money chasing the same stocks, so stocks go up. So yes, eventually, after a period of between 3 to 6 months, depends a bit on the situation, you start to see the big ramp up on stocks and other risk assets, like crypto, anything, except the commodities. Why? Because since we are expecting a recession, things like construction, things like maintenance, things like new buildings, things like new cars, all of these things slow down. All the commodities are used in these industries. So typically, the price of commodities goes down despite the money printing. Okay, very important. Now, when it comes to crypto, we are once again a bit in the boring stage. We are getting out of the recovery year, but we are still in the recovery year. I made this very clear. We are not in the full bull market yet. That's when things are going up, 20% per week, or in some altcoins, 20% per day. That's not happening yet. What is happening is still we are climbing the stairs. So, for example, people now talk about Bitcoin crashed to 36,000. Flashback 3 months ago, you would dream of 36,000. Oh, Ethereum crashed to 1980. 3 months ago, you would dream of 1980. So that's the point. It's what you're doing is you go like this and you climb a stair, and you go like this and you climb a stair, and you go like this and you climb a stair, and sometimes you go down a couple of stairs and you do the same thing again. That's what typically happens in the recovery year. It's very boring. So what do? Not financial advice. I'm not telling you to do this. This is what I do. If I see major sell-offs in coins that I like, I accumulate a lot, or I accumulate as much as possible in order to not jeopardize, obviously, my life. Why? Because I can be asleep and all of a sudden the coins are up 30%. And if I like the coins 30% up, then I should like them with a 30% discount. This is the key. This is where people get confused. If I like Bitcoin at 50,000, I should like Bitcoin even better at 15,000. Obviously, the big whales, the richest individuals, they do like it. The retail investors, the small players, the small wallets, they like crypto at 50, 60,000. They like to pay $1 million for JPEGs. They like to pay. They like to buy coins after they already ran 100x, like Pepe. They don't like Pepe here or Shiba Inu here. They like Shiba Inu after it went up 1,000,000-fold. That is the problem. But this is the nature of markets. People buy because it's going up, and people sell because it's going down. And if you have more buyers, things go up. If you have more sellers, things go down. All the rest are narratives, are justifications for what is happening. So the charts will tell you the news of the day. If the stocks are down, there's going to be a news on CNBC justifying the stocks being down. And it's so funny because sometimes stocks open deep in the red, like minus 1% or so. And then you look at CNBC, Bloomberg, Financial Times, and they say stocks are opening like this due to fears of a conflict in the Middle East, blah, 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 scaling up. But then, because we are about to touch a big level of support, we have a huge reversal and the stocks actually end up green. And the question becomes, okay, so what happened this afternoon, right? For the fears to go away? The answer is very simple: nothing. They are making the news based on what the charts are saying at the moment. That's it. If the charts are green, all of a sudden nobody cares about A, B, C, and D, and people are pricing this and that. But then if it reverses to negative, then something happened, and all of a sudden people are now concerned. So basically at 9 a.m. they are not concerned, but then at midday they become concerned, and then by 3 p.m. they are not concerned again. And this is the thing. Charts will tell you the truth. Charts are not farts. Farts is what I consider what the journalistic opinion on most of these matters is. Of course, charts are not everything. There are something called fundamentals. But fundamentals, you should look at them in a general trend. Don't try, like for example, on the oil side, I made the prediction, you may recall, when we were in August or something, and oil was going just straight up. And I was saying, my charts are telling me that there's a big pattern topping about end of September, beginning of October, right? And then somewhere mid-September, all the hedge funds were making bets of $100 oil. And I said, oh yeah, then we're going to stop at less than 100, and we should be getting then to the top. Why? Because if they are telling you that they are expecting $100, they already bought. What can they do after they bought? Sell. And because they know everyone is pricing $100, they have an incentive to front run the $100 and sell it early. So what happened? While everybody was saying, oh yeah, oil is now going to 150, 200, 175, 250, secular bull market on oil, all of this kind of stuff. End of September, 28th of September to be exact, oil WTI crude hits $95 per barrel and drops. And even with the Middle Eastern conflict that's happening right now, oil never touched the $95 once again, because that's how powerful the patterns are. So my point is, having an idea of the fundamental situation and where these things should go, it's very important. Combined with the charts, and you can take out a lot of the noise. And you need to realize this. Both news and YouTube get fed on the same thing: attention. So they need to find relationships with everything. These flowers are growing and now the stock is up. So if these flowers grow, the stock goes up. And particularly on the negative side, because we as human beings prefer, unfortunately, that is how we are wired, we prefer to hear the negative before the positive. So all these channels, or all the news, are tailor-made to shock you constantly. There's always something dramatic happening, and it's always these big, many times conflicting predictions happening at the same time. And the idea is the same. It's not to educate you, it's not to teach you, it's not to help you, it's to shock you, make you watch. That's all. If you realize that, you understand that everything they're telling you, eventually they will be right on something. Because if you make predictions on a daily basis, you're going to be right. I mean, unless you're like Jim Cramer, but apart from him, you're going to be right on something, right? And then you can make these connections between what you said and some random stuff. And then the thing is, if you're right once, if you're right twice, people tend to expect you to be right 3 times, and they don't realize that your number 1 and 2 was completely by chance. But in any case, I went through a bit of guidelines here. I do expect us to retest the 4,600 mark. I don't think we're just going to push through it. The longer we stay above it, the more likely it is that we're going to create an upper new channel, meaning higher prices. And NASDAQ 100 is now pretty close to a new all-time high. We'll see if that's going to happen. And I think Dow Jones is also fairly close to a new all-time high. So again, the pricing of rate cuts is happening. I think one thing that can derail the markets is, I would say, if inflation data starts to come in again substantially hotter than expected. And with this, if they are predicting rate cuts and money printing, the dollar is also losing somewhat of its value versus the other currencies. So thank you very much, guys, for your time. I'll still make a video a bit later tonight. And don't forget, like and subscribe, and I'll catch you in the next one.